Hi, I'm Peter Rose, founder of Longwood Currency Trading. 3 rules to turn the odds of trading Forex in your favor as opposed to the 90% odds against you. That's what I'd like to talk with you today about. I was going to do this outside, but as you can maybe see, outside is not really possible. You can hear the rain, maybe. It's been raining all day and it's cold. This is early October of 2024, so it should be cold in the Lakes region of New Hampshire. I'm going inside because it's warmer in there and probably not quite so noisy with the rain dripping off all over the place. So let's go inside and get this video going. Alright, it's much warmer in here. I've got my coffee. And so let's get into this. 3 rules to change the odds of your Forex trading in your favor. I did a video not long ago where the title of the video was that the odds of trading Forex were 90% against you. So you might want to go back and look at that video first, and I'll put that in the show notes, a link to that in the show notes, because it sets the groundwork for the reasoning behind this video. You have to know why the odds are against you first before you can see how to change those odds to be in your favor to make any sense of that. If you're consuming invalid information, you're going to have the wrong idea about how to go into the process of the analysis necessary to trade Forex successfully. And so take a look at that video first and then come back and I'll see you again in 20 minutes or so. But what I wanted to do here was just give 3 really stupid, simple concepts or rules that will help you in your trading to begin to turn the odds of your Forex trading in your favor instead of working against you. I'll give you the 3 rules up front, so if you have a short attention span, you can go on and watch Mr. Beast. Number 1, risk management. Number 2, understanding currency order flow. And number 3, have solid entry analysis conditions and guidelines. Okay, first one, risk management. Warren Buffett has the greatest risk management rule ever. Rule number 1, don't lose money. Rule number 2, see rule number 1. It just couldn't be any easier than that. Where do we lose money in our trading? Where? Because the trade goes against us. And we lose a lot of money when we don't get out soon enough to limit the amount of loss. You have to have a basic understanding of your general trading metrics in order to determine what that loss factor should be. I mean, if you're trading a couple of full lots at 20 bucks a pip, is a 10 pip loss of $200 acceptable? Would you want to go out to 20 pip loss? And then the risk becomes $400. What happens when you have a $400 loss? Are you going to freeze up and not get out of the trade because you're hoping it'll go back and you won't lose $400? That's the problem that we're all faced with. And if you're trying to figure that out in real time, every time, then you either, number 1, don't understand how to implement your trading metrics into your general trading process as part of your trading plan and building your rules, or number 2, you don't really understand your psychological makeup and how that's going to screw with your head. I've done quite a few videos. There are 440 some odd videos, 440 videos that I've done so far. And many of them deal with what I consider the simpler aspects of risk management. Make the risk management simple so that you never have to factor into your trading risk management again. It's already done. And that simplifies all of your rules, because every time you're trying to execute a rule, if you're going through risk management, you're going to drive yourself crazy. And so I've simplified it, and I have my course and consulting structured such that we deal with that right up front so that we never have to visit it again. So if you're failing in your trading, the fault lies in not adhering to the principles that you set up initially in the framework of your rules, setting up the framework for your rules of dealing with this concept of risk management, up front. Number 2, understanding currency order flow. Currency trading is a zero-sum game. It's different than trading options or stocks or whatever. The currency position is a phantom thing. It's a construct as opposed to a stock certificate or an options promise or a bag of sugar for commodity trading or whatever. If you don't understand that differential between the currency market and all the other markets, that's going to be a problem, because order flow is based on that principle. So you need to understand that the currency market is a different premise. Just because you can trade stocks successfully does not mean that you can trade currencies successfully. There's a major mind shift that you're going to have. However, if you know how to trade currencies, particularly day trading them because you've had to make many decisions and found out all the intricacies of trading itself, you can map that information and techniques and methodologies from currency trading to stocks or commodities or cars or old tires or real estate. I did real estate for 40 years, and I'm not borrowing real estate rules to trade currencies. I wish I would have started with currencies because I would have had a better set of rules than in order to trade real estate. I learned real estate really well, and over the 40-year career I had in investing, I was able to retire a millionaire because of my real estate investing, not because of my software engineering salary or anything else. It's because of my real estate investing. So I understand order flow, supply, demand, all that sort of stuff. But it's different in the currency market because the currency market is different. So you need to understand currency order flow. You need to understand, and it's not as simple as saying, oh, it's the supply demand. Yeah, it is, but the supply demand is a result of the order flow. The order flow isn't a result of the supply demand. And everybody that I talk to has that inverted, and it's probably because of the education that you have, and folks simply, maybe they can do it, but they simply don't recognize how to present that and teach it. You, on the other hand, knowing now that you need to understand currency order flow, are going to be hyper-focused on that. Second rule, understand currency order flow. 3, have solid entry analysis conditions or rules or whatever. Where are you going to lose your money? We're back to rule number 1. You're going to lose it because you didn't get out of a bad trade. Well, where is the trade a bad trade? At entry. Are you going to have a bad trade once you get into position management and the fuckers run 6 or 8 or 10 pips? Should you be losing money after the trade has run 10 pips? No. That has to do back to risk management. All these things have to be solved up front. That's why if you solve the risk management, you're all set. But you do have to understand that if you have crappy entry analysis, then you're going to get stopped out all the time and lose more times than you would care to. And in addition to that, you may very well be losing more money when you lose than you win when you win. I mean, it's okay to invert a 60-40 win-to-loss ratio to a 40-60 as long as the average win value of the position is, 2, 3, 4 times higher than the loss. But since we have no control over how much we're going to win, it's all based on the loss. So you guys that are listening to these people that are trading and saying you can make money as a 50-50 jump ball trader, and some people are making money with less wins than they have as losses, those are pros. Those are people that really know how to trade. If you don't really know how to trade and you don't understand the inversion of the win-loss ratio, or you don't understand the other metrics that comprise the trading process and how to use those in real-time execution of your trades, you're going to be hard-pressed to have any odds turn in your favor. So the entry analysis is the primary problem that you need to solve. In the life cycle of a currency position, which is something that I created from my 33-year career as a senior software engineer, designing complex business applications and using what's called the software development life cycle, the SDLC, which is a process of problem solution by taking a very complex problem that you're trying to solve, breaking them up into smaller individual problems that are easy to solve, solving those problems with sequential conditions, going to the next problem and solving that, hooking the two solutions together, iterating back over those two, and then solving the third one and iterating back over those three. That's the software development life cycle. There are many, many, many steps in the software development life cycle. In the life cycle of a currency position, there's only 3 phases: entry analysis, position management, and exit methodology. If you don't get your entry analysis correct, you won't have a position to manage and you won't have anything to get out of. So you don't need to worry about the rest of the thing. You don't need to worry about your career as a trader. You're done. If you don't have good entry analysis, and there are people out there that say, oh, you don't have to worry about your entry, anybody can pick an entry. It's managing that position to success. You can't manage a position to success. You can't drag anybody across the finish line to success. All you can have control over is your risk. So the folks that are telling you how to manage your position as a priority over your entry analysis are flat stupid. They don't know what they're doing, regardless of whether it's successful or not. You can have some fool run through a minefield and stand on the other side of the minefield and say, I ran through this minefield. I'm a success. You should follow me. And you're going to get your ass blown off. He made it through, but he doesn't know how he made it through. And he probably couldn't make it through again. But he's going to tell you how to do it. And unfortunately, that's the state of currency education, because it's not checkable. How do you check something stupid like fibs or all that kind of crap that people are telling you? It's easy to check something in real estate. If I was buying a building and I had a question about the integrity of that building or whatever, I'd ask somebody who'd done it, and they'd go, oh, think about it this way. I go, oh, okay. I'd implement that, and I made $1 million doing that, because the information that I was getting for the solutions to the problems I had was valid, and it was immediately identifiable as either valid information or poor information. And poor information didn't survive in the ecosystem of the real estate investing market because it was very easy for someone to say, don't do this. And it's very simple for someone to visualize and say, oh yeah, I can see now that you've pointed out that that's something that you don't want to do. But some asshole that gets in there and says, oh, you buy this property and you sit on it and you get an 8 or a 10% appreciation on that, and then you get your cash flow and blah, 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 and real estate's the way to go. I know more dumbasses in my 40 years of investing in real estate that lost money in real estate because they didn't understand risk management and how the order flow of the real estate market functioned. And so your entry is critical. The decision to buy that piece of real estate is critical. The decision as to when you hit bid ask on a currency trade is critical. And so you have to have solid entry analysis conditions in order to increase the odds in your favor of a successful Forex trading. So to summarize, rule number 1, risk management. Rule number 2, you got to understand currency order flow as it really exists and not some fabricated stupid crap that someone else is telling you it is. And number 3, you have to pay particular attention and focus your energies on that first phase of what I call the life cycle of a currency position, which is your entry analysis. If you have any questions or thoughts on that, feel free to send me an email. I'd be happy to address them to you. I'm not going to address that stuff in comments because it's just garbage and trash that comes out. I'd like to have a conversation with you and try to help you through this stuff for no charge, unless you're looking for, how do I trade? How do I do this? Well, then you're going to need a course or consulting or something. I'm probably not the person that you want to do if you're not really serious about trading or working your way through to either replacing or substantially affecting the replacement of your job income, because the cost that you'd have to pay exceeds the value that you would get if all you're trying to do is pay your light bill. And I'm also I've taught martial arts for 50 years. I know how to instruct. I know what goes down. I don't want people that I have to drag around the room trying to convince them that these are the things that you have to do. So if you're not willing to accept a good educational process, then maybe the email that you send me and the questions that I can answer very simply, maybe that's all you need, because I'm not going to put any demands on you. You're going to ask me a question, I'm going to say, hey, have you tried this? And you go try it. But if you ask me another question to that question or another question to that question, then you're going to need more. So you have to be willing to put the time and the effort in to the solution process for that, right? I mean, that just makes sense. You don't go to high school and graduate in 15 weeks. It takes you 4 years, and it's hard work. It can be made simple by understanding the study process, or it can be hard because you don't like it, and you don't want to do it, and you don't want to pay attention to what the teacher's trying to tell you. Of course, you could always have a shitty teacher, too. But do you know the difference between a shitty teacher and a good one? Right when you're in the middle of all that? Probably not. So step back from everything and look at it clearly so that you can see that, number one, the odds are 90% against you in currency trading. Go look at my other video just to make sure you understand why that's true. That's not bullshit, that's true. So if you don't want to be part of that 90%, then think of it this way. The 10% who are successful in currency trading make all the 90% losers, they make all that money. There's a lot of money to be made in currency trading, but you do have to know what you're doing, and the odds are 90% against you. So the 3 simple processes that I've just shared in this video will help you increase the odds of your success to successful trading: risk management, currency order flow, and solid entry analysis. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.